Stop losses. Even the name sounds good. But contrary to some investors' beliefs, they often cause some of the biggest upsets for amateur investors, leading to huge losses and missed gains in the financial markets. Let's talk about this money-losing strategy and why investors should stop using them. Welcome to another episode of Money Matters. All investors hate losing money in the markets. In fact, we are twice as sensitive to losing money as we are to making money, as behavioral finance studies have shown. And when brokers talk to their clients about a way to limit their losses, of course, investors will be interested to implement this strategy. They talk about setting a stop loss. A stop loss will automatically sell a stock when it falls to a specific price. It is meant to limit the potential loss of a position. You can pick any arbitrary amount, or your broker may pick one for you. Maybe there's a special formula to come up with a stop loss price. Whatever the case may be, when the stock hits that price, it automatically gets sold. So instead of losing potentially a huge amount, like 50%, 60% perhaps, more, you can limit the stop loss to say 10%. Sounds great, right? Except stop losses don't do what people want them to do. A more accurate name for this feature should be cement losses. Why? Let me explain. The first principle of market investing is that you have to expect price volatility, or market risk if you prefer. The prices of your positions will rise and fall with market sentiment and react to whatever news that becomes public. Markets will ebb and flow over time. So if you set the stop loss for a small amount, then it will create a loss for you when the market falls. But you'll miss out on the following gain since you're out of the market. So then we set the stop loss at a greater amount. This way it allows for markets to ebb and flow, but stops the big losses if any one company comes into any specific issues. But how do you set that price? And how do you know the company won't bounce back from that price? The answer is, you don't. Take the pandemic, for example. Major indices lost 30% and more during March of 2020. But then bounced back strong and continued to make back the losses and followed with continued gains thereafter. Picking an arbitrary figure to automatically sell is a disaster and a surefire way to cement losses in the financial markets. It turns a paper loss into a real loss. It's great for brokers. They make money on your transactions. The more transactions, the better. Investors think that a losing stock will continue to lose, but they already know that this is not true. Past movements have no indication on where it will go next. Let's say a stop loss gets triggered and you're waiting for the right moment to enter back into the market to make the gains on the bounce back. But again, how do you know when the price is on the rise again? Price movements are not consistent, so maybe you'll use moving averages to smooth out the movements. Do you use a 15-day, 20-day, 30-day moving average? Maybe you'll use moving average convergence, divergence, by subtracting the 26-day moving average from the 12-day moving average. At the end of the day, it's easy to see the point of inflection looking back on the event that's already happened. It's near impossible to spot it in the heat of the moment. And when it bounces, there's no way of knowing how much it bounces. Like I said earlier, past movements do not indicate future movements. Okay, let's simplify things a little. Let's say your stock drops 20%, triggering your stop loss. So your position is sold. But that was because the entire market fell that much and your stock was along for the ride. That was not the stock's fault. There was nothing wrong with it. You sold at a relatively low price, paid a transaction fee, and are now holding cash. And then the market rebounds fast. You're in cash while the market and the stock you sold quickly goes back up. And this time you're not along for the ride. You bought high and sold low. Or in another scenario, some bad news came out, triggering a drop in the stock price. The stock gets automatically sold and you're holding cash. But now do you buy? Can you guarantee that what you buy goes up? Maybe you buy a replacement stock with a 20% stop loss. Then that one drops 20%. You play the game of buying 20% losers. Stop losses don't guarantee that future purchases only rise. Here's another perspective on stop losses. Let's say you bought a stock at $50 and it shoots up to $100. Then your friend buys it too after seeing such great returns. And then it drops to $80, which is, losing 20%. Should you both sell, or just you, or just him? There's no evidence that stop losses are a good strategy for investors, only that they make more transaction fees for brokers. Try to name one successful fund manager using this strategy, or even promoting this. I can't think of one. They are just costly security blankets for nervous investors who don't accept the first rule of investing, that markets are volatile and you have to accept it or simply don't play. Accept that markets ebb and flow, and then you're good to go. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in the future videos. If you like the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.